To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Now we'll understand the next set of financial formula which you will be using a lot, which is the net present value and the internal rate of return formula, which we normally call NPV for net present value and IRR for internal rate of return. Now before we jump into understanding how these formula work, let us take a very small example to understand what NPV means. I'll not go into great details of that, but you need to understand how Excel derives the NPV and how Excel derives the IRR. So say for example, we again talk about an asset that you have purchased. Let us say you have purchased a machinery. So we have purchased a machinery and the cost of that machinery today is, let us say, 5 lakhs. The cost of the machinery is 5 lakhs. 5 lakhs is the amount that you have paid today, right? So let me just convert this into comma separators using Control Shift 1, and this machine has a useful life of, let us say, 4 years. So the life of the machine that we are talking about has a useful life of 4 years. Now this machine that you have purchased, you basically want to give it out on rent to somebody. That is your business. You want to give it out on rent to somebody. The other person will pay you some amount every year. So what you did was, every year, year 1, year 2, year 3, year 4, at the end of every year, the other person has agreed to pay you certain amount as rent. And we'll assume that the rent is not constant, but the rent keeps on increasing every year. So in the first year, he agreed to pay you a rent of 1,25,000. So at the end of the first year, the person who has taken this machine from you will pay you 1,25,000. Then in the next year, he'll pay you 1,35,000. Then in the next year, he'll pay you 1,50,000. And in the last year, he'll pay you 1,60,000. So this is the rental income that you will get. We'll forget taxes and other aspects, we'll forget it for now. We'll just understand how the NPV formula works. The detailed understanding of this you will have when you understand financial management. So this is the year, this is the rental income, right? Every year you pay. So let me just convert this into decimal, Control Shift 1. So I've reduced the number of decimals. So every year you get some amount of rental, and if I total this up, there is a total inflow or there is an income of 5,70,000. Now you will say, I paid 5 lakhs today, I got 5,70,000 in the coming 4 years, and hence there is a net profit of 70,000. This is what you can calculate, but one thing that you are missing here is the time value of money. We have already discussed that whatever amount you receive after 1 year or after 2 years, that amount as on today will be of a lesser value. This future value that you have received will be of a lesser value as on today, right? If you receive 110 after 1 year, considering 10% discount rate, the present value is only 100. So this is the rental income. So what you also expected is, you expected a return of, let us say, 10%. Return of 10% is what you expect. So now at 10%, we have to see what is the present value of all of these income that you will be receiving in the future. So what we will do is, we will compute the present value. We will compute the present value, right? Now, how do we compute the present value? We know 1,25,000 is received after 1 year, and this includes 10% interest. So we have understood one formula where we said amount is equal to present value multiplied by 1 plus r to the power of n. So basically what it means, amount after 1 year will be equal to present value multiplied by 1 plus r, that is 1 plus the rate to the power of n. So in that context, the present value will be equal to amount divided by 1 plus r to the power of n. 1 plus r to the power of n. So whatever is the amount you receive after 1 year, you can apply this formula to get the present value. So for this, for the first year, the amount that you receive after 1 year, what is the present value? So you have to consider amount, that is A, the first thing out here, divided by 1 plus r. So 1 plus r, what is r? return is R. I will log this because it will make it easier for me to copy the formula, to the power of n. What is n? N is the number of year. So the amount that you have received after 1 year, which is 1,25,000, if you have to compute the present value of this, you will do 1,25,000, that is the amount, divided by 1 plus rate, that is R, which is 10% in our case, to the power of n. Now what does n represent here? N represents number of years. So for the first year it will be 1, for second it will be 2, 3, 4 and so on. So I close this bracket, I get 1,13,636. So I'll convert this into comma separator and I'll hide the amounts after decimal. So though you got 1,25,000 after 1 year, today's worth of it is only 1,13,636. Same formula I can copy it for the next cell. 1,35,000 after 2 years is worth 1,11,570 today. So like this I can copy these two things. Now the present value, if you total it up, 570 in here, it is only 4,47,186. So though on the face of it you are making a profit, but if you look at the cash flow, you are only getting 4,47,186. So what is the net value as on today? You have 447,186 of inflow, that is what will come to you in present value terms, minus 5 lakhs is what is the outflow. And we are only talking from cash flow perspective. We are talking from what is the amount of cash you got and what is the amount of cash you are paying. Now when I say cash, I also obviously include the bank thing as well. We are not talking about profits, we are talking about cash flows, right? So if I do this, I get minus 52814. This is what we called NPV. Now how did I get this? NPV was nothing but present value of inflows minus present value of outflows, right? So whatever is the present value of inflow, in our case minus 5281. So whatever is the present value of inflow, in our case 447,186, minus whatever is the present value of outflow, which is 5 lakhs. Now since we have only single cash outflow, this 5 lakh remains 5 lakhs. But if you have outflows also over different years, right, in that case you have to bring the discount that and bring it to the present value. Obviously that is not in our scope of discussion. You just need to understand what is the basic logic of NPV and how does Excel work around with NPV. So if I just include one more item here, year 0, that is present date, that is as on today, and I just change this to cash flow. At year 0 I had a minus 5 lakh. Now what does that mean? There is a cash outflow of 5 lakh. And what is the present value of that? If I pay 5 lakh today, that is at year 0, the present value is also 5 lakhs. And I can update this formula, this is no longer needed, and I can include this formula to include 8, right? So and this can delete this too. So my NPV is 52,814 negative, 52,814 negative. Now the other way to understand this is, this particular business that I have done, purchasing a machine and giving it out on rent, is not giving me 10% return. It is not giving me 10% return. Now what happens if I reduce my expectation of returns to 9%? You see it has become 42,519. If I reduce it further to 8%, 31,000. If I reduce to 6%, negative of 9,000. If I reduce to 5%, now here is where it has become positive. So at 5%, the net present value is positive, right? Now one thing that you would have observed here is, as I was reducing the interest rate, the present value of cash inflows were increasing. If you observe here, present value of inflows, that is the sum of these 4, it is right now 5,02,705. If I increase this return to 6%, it has come down to 4,90,000. So as you increase the interest rate, the present value will decrease. As you reduce the interest rate, the present value will increase. So at 6% it is 497.52, right? So this is how the present value keeps on fluctuating. So let us go back to our 10% example, and we know the NPV is 52,814. Now to compute the NPV, we have a formula in Excel which is NPV, that is the net present value, right? And for the net present value, what is the rate? The rate is 10%, that is the first parameter, and then you have to select the values. Now in this case, we will just select the inflows first and check whether this formula is working properly or not, and then we will include the outflow and see what was the difference, and then we will try to move on to the improvisation of NPV, which is the XNPV, right? So NPV B5 is my rate, and I will select all the inflows year 1, year 2, year 3, year 4, and I will close the bracket and I will hit enter. You get 447,185.98, which is nothing but your present value of inflows, right? So this actually can give you the present value of the selected amounts. Now it not only gives you the present value of the inflows, you can actually include the outflows and again compute the net present value. So basically you can have inflows as well as the outflows, and then you can compute the net present value. If I update this to include B8, if I do this to include B8 and I press enter, I get NPV of 48,012.74 negative, but the way I computed, I got 52,814. Now why is there the difference of 4,000? The reason is Excel, the NPV formula considers all the inflows and outflows to have happened at the end of the year, because we have a cash outflow at the beginning of the year, but when Excel did the computation, it assumed that even this 5 lakh is at the end of the year. So now, because Excel has considered that this particular outflow is also at the end of the year, and for Excel now it is year 1, this 5 lakhs of outflow is at the end of year 1, this 1,25,000 is at the end of year 2, this is at the end of year 3, year 4 and year 5 and so on, because nowhere here did I define that this is year 0 and this is year 1 and this is year 2. For Excel, it starts counting as if this is year 1, this is 2, this is 3, 4 and 5, and all at the end of the year, and that is why we have got a inconsistent inflow. Now to change this, what we will do is, we will simply copy this outflows, paste it here. So here it is minus 5 lakhs. And this has to be B5, right? It says 4812. Now to change this, what we need to do is, for Excel, this 5 lakh is also at the end of the year. So what I will do is, minus 5 lakhs plus 1,25,000, that is minus 3,75,000, I will include here, minus 375, I will include here, and I will actually delete this, right? I will actually delete this. Now what has happened? NPV as per my computation is also 7359, and NPV as per Excel's computation is also 7359. In fact, this G8 is not needed now, this becomes G9, right? Then also it is 7359. Now why did this happen? Now here it is very clear that at the end of year 1, there is a net cash outflow of minus 375, end of year 2, there is an inflow of 135, year 3 150 inflow, year 4 160 inflow. Now the assumption that has changed in the second case is, the 5 lakh that you have invested is not at 0, not as on today, but at the end of the first year. It is at the end of the first year, and because of that your NPV computation has changed. Because of that your NPV computation has changed, and now you can see after updating this formula, the NPV has come out to be absolutely correct. Now let's look at the next formula, which is the IRR formula, and again here I have copied the same data set that we have used for NPV. We'll understand what is the meaning of this IRR. IRR stands for internal rate of return. Now for example, in this case, if I want to find out what is the rate of return that I am getting by buying a machine at 5 lakhs, giving it out on rent in this manner, what is my rate of return? What is my rate of return? What is the return that I am earning after considering the time value of money? That is what is given by IRR. And now for that, there is a trial and error method to compute the IRR, which we do not need to do because now we have Excel with us. So let us see how do we compute that. Equal to IRR, then it says values. So you just need to select the various values that you have, and it says guess, guess you can exclude it, that's not mandatory. You hit enter, it tells 5%, and if you actually increase it, it says 5.223%. Now this basically means this series of cash flows is going to give us a return of 5.223%. Now as compared to NPV, the change in IRR is the first cash outflow is assumed to have happened at year 0 and then these at the end of each year, which was not the case with NPV. Now if I change, if I copy this IRR and if I link it back to my return and to compute the present value, because my present value is linked back to the return. So if I change this to the IRR, you will see that the NPV has become 0, the net present value has become 0. Now does it mean that I have not gained anything? It doesn't mean that I have not gained anything. It basically means considering the finance cost of 5.223%, right? Considering the cost of 5.223% or considering a return of 5.223%, the present value of inflows is equal to the present value of outflow, and hence the NPV becomes 0 at IRR. So at the internal rate of return, basically what we are trying to figure out is what is the present value of inflow, what is the present value of outflow, both of this becomes equal and hence the NPV also becomes 0. So if you come to the total of inflow, the sum of inflow is also 5 lakhs and the present value of outflow is also 5 lakhs. So basically at the IRR, the present value of inflow is equal to the present value of outflow, and this tells us what is the return we are earning from the project. Now if I need to earn more, maybe I have to increase the rentals, right? If I need to earn more, I have to increase the rentals. If I still am happy with a lesser rate, I have to reduce the rentals. For example, I realize that if I do this scheme of things, my return will not be sufficient. So let me increase the rental to 135 and 145. Now the moment I do this, you see that IRR has increased to 6.769%. So like this, by changing the inflows, you can change the IRR. Or other ways, instead of buying a 5 lakh machine, I buy a 4 lakh machine and try to get the same rental, and then you will see the IRR has gone up to 17%. So this is how you can use the IRR formula to compute what is the rate of return on the given set of transactions. Now again, here the assumption is this is happening at the beginning of year 1, this is end of year 1, end of year 2, end of year 3 and end of year 4. This is the assumption. But what if my cash flows are not consistent? What if my cash flows happen at some specific dates? Now in that case, how do we compute the IRR? That we'll understand with another set of data. Now let's say our inflows and outflows are based on certain dates, right? We have specific dates and based on that we have to compute the IRR. Now in this first case, I have just assumed that it is 1st of January of 21, then 1st of January of 22 and so on, like we have done in the earlier case. With these dates, we will compute the xirr and then we will try to change the dates and see how the IRR changes, right? So when we include the dates, we will use the formula xirr. So equal to xirr. What are the values? Cash flows are my values, and what are the dates? These are my dates. And you close it. It says 0.76922, it will be the same percentage. The reason being, I have considered dates in line with the years that I have considered here. Now, if I change these dates, let us say instead of 1st of January 21, this is supposed to happen on 1st of January of 22, then my IRR automatically changes from 6.769 to 7.55. This doesn't change because here I have not defined the dates. Here I have defined the dates, and based on the dates, the IRR is computed. So this xirr will be useful when the dates are not consistently spread out. For example, it can be at any random date if you receive some cash flow. For that, if you have to compute the IRR, then you will use the xirr. So you need to understand two different aspects. NPV, the basic formula, will be used without dates. XNPV will be used with the dates. IRR will be used without dates. XIRR will be used with dates. So with the help of these two formula, you will be able to compute what is the NPV and what is the rate of return. Now the concept of this IRR is also useful to value bonds and debentures. Now whenever you have bonds and debentures and you have paid a premium or you have paid a discount, you can use the cash flows, you can plot the cash flows and find out what is the effective rate of interest. What is the effective rate of interest? So we'll take a small example to understand that as well. Now let's see how we can use the xirr formula in case we are dealing with bonds and how we can find the effective rate of interest. Now say there is a bond which has a face value of 1 lakh, right? That is what is the face value, and it has been issued to the investor at 90,000. So basically the issuer got it at a 10% discount. So what is the amount that the investor has put into the bond? He has put in only 90,000. On this he is entitled for 10% rate of interest. He is entitled for 10% rate of interest and it will be redeemed after 5 years. So basically what is the structure? You pay 90,000 to the company gives you a bond worth 1 lakh. On that every year you will get 10% interest, and at the end of 5 years you will also get the principal back, and in this case you will get back 1 lakh and not 90,000. So you got something worth 1 lakh at 90,000 and after 5 years you will get back 1 lakh. And the coupon rate, that is the rate of interest which will be paid to you, is 10%. And always remember, interest is computed on the face value. Interest is computed on the face value. Now I have plotted the cash flow. As on the start of the period, that is on 1st of January of 21, you have paid 90,000, that is the outflow. On 31st of December of 21, that is at the end of the first year, you will get 10% of 1 lakh. It is not 10% of 90,000, 10% of 1 lakh. So like this you will get 5 set of interest, and on 31st December of 25 you will get back 1 lakh. Now if you want to figure out what is the effective earning that you have got in this particular transaction, so for that we can use xirr, which is xirr, then select the values and then select the various dates, and you can close the bracket and press enter. You get 12.83%. Now one thing you have to understand here very carefully is two dates are repeated here. But xirr still calculates the internal rate of return correctly. If you would have just used the IRR formula, you just select the values, it would have given only 11%. The simple reason being, for IRR this is year 0, 1, 2, 3, 4, 5 and 6. That is why it has given you 11.11%, right? So that is a basic difference between using an xirr and using an IRR. So always prefer to use xirr instead of IRR, right? So this is the thing that we will be using. Now let us compute and see whether it is correct or not. So to understand how this effective rate of 12.83% works, let us prepare a loan schedule with interest. So on 1/1/21 we have paid 90,000, right? On this we will earn interest effectively at 12.83%. I'll just lock this. But we will get payment of 10,000, right? So payment that we will receive will be of 10,000, and based on this, what will be the closing balance? Opening plus interest for 1 year minus payment that you receive. This will be the closing balance as at the end of the year. This is not the closing balance as on 1/1/21. This is the closing balance as at the end of the year, that is on 31st of December of 21. So the next date would be 31st of December of 21. Okay, opening balance now would be, or the balance as on 31st of December of 21 would be 91,550, interest is 11,749, payment is 10,000, closing balance is 93,299. Now this closing balance again is after 1 year. So this closing balance is as on 31st December 21, this is as on 31st December 22, right? Now again I can move to the next year, 31st December of 22. So here you can use Control D to copy the formula, interest, payment, closing balance. Then we have 31st of December of 23, interest, opening balance, interest, payment, closing balance. 31st of December of 24, opening balance, interest, payment, closing balance. Now this closing balance is 1,14.33. Now what happens is, on 31st of December of 25, this is the opening date, after 1 year, that is on 31st of December of 25, you will get this plus 1 lakh. And the closing balance shows 14.33. That is because of a rounding difference. That is purely because of a rounding up difference, because there is a leap year in between, and that is why there is a slight rounding of difference. Now to get it perfectly, you can change this to 31st of December of 20. That is one date which needs to be changed, and here it has to be 30th of December of 24 and 30th of December of 25. Now you can see the closing balance has become 0 once you have set right the dates, right? Because if you start from 1st of January of 21, then Excel will ignore that first date and compute the interest and then compute the IRR. That is why there was a small difference or the rounding of difference. But for our understanding, we will keep it. That doesn't make much of a difference. So there is a rounding of difference of 14.33 which you can ignore. And this is how you have effectively earned 12.83% rate of interest, though the quoted rate is only 10%, and the simple reason is you paid only 90,000 when you bought this particular bond. So like this you can find out effective rate of interest using IRR or the xirr formula.